Yeah, it's been a week. So Canada just slipped into a technical recession. The Bank of Canada released their financial stability report, telling us the mortgage market is basically fine, while also suggesting the labor market is frozen and it's not because of rates. Middle East peace is still just a hope and a vibe, not a plan. We are going to unpack this. If you're new, I'm Becky, independent mortgage broker, trying to make it make sense for you and your mortgage decisions. Stats Canada confirmed that Canada's economy contracted for 2 consecutive quarters on an annualized basis. This is the technical definition of a recession. Now, before we panic, the contraction is slim. 0.1% annualized in quarter one after a 1% drop in quarter four. Some economists think it could be revised away, and April's preliminary numbers look like a bounce. So, no, it's not 2008, but here's what I want you to sit with. Business Capital Investment just posted its fifth consecutive quarterly decline. Companies have been pulling back for over a year. Hiring's basically stopped, and the economy surprised analysts to the downside. They were expecting 1.5% growth and got a negative 0.1%. Now, let's talk about the Bank of Canada. On Tuesday, a senior official suggested the job market problem might be structural: AI, aging workforce, skills mismatches, and that rate cuts may not actually fix it. Okay, I'm sorry. What are we talking about here? Here's the timeline. The bank raised rates 10 times from 2022 to 2023, 0 to 5%. Unemployment was around 5% when they started. By the end of 2024, it was 6.4%, and it's nearly 7% now. We found out we are in a recession, and the bank's own research said their rate hikes eliminated excess demand and slowed hiring. This is their words. So the rates went up, the hiring slowed, the economy contracted, but now we're being told it might not be about rates. Look, I'm not saying that those structural factors aren't real, but the bank is sitting at 2.25%, what they call neutral, not stimulating, not helping, just treading water in a recession. That's a problem. Now, deep breath. The financial stability report had some genuinely good news. It's nice to talk about some good news. That renewal cliff that everyone was worried about for 2 years, it looks more now like a speed bump. The last wave of pandemic era 5-year fixed mortgages renews over the next 12 months, about 12% of all outstanding mortgages. The average payment increase is about 15%. While that sounds painful, comparable borrowers have already absorbed that same increase over the last year, and most of them have managed. Now, why have we managed this crazy renewal cliff? Household disposable income grew about 16% between 2021 and 2025. The stress test did its job. Over 90% of recent renewers came in below their original qualifying rate, and some people just extended their amortization to ease the burden. By the second half of 2027, nearly everyone facing a big payment jump will have already renewed, so that risk is essentially done. Now, mortgage arrears nationally are still barely above the 2018-2019 average. The stress that we're hearing in the media is concentrated. Toronto area borrowers who bought in 2022 and 2023 with high debt to income ratios. This is real pain for real people, but it's about 2% of outstanding balances. So this is not a systemic crisis. One more piece of good news. National Bank reported that Canadian housing affordability just posted its ninth consecutive quarterly improvement. Mortgage payments as a percentage of income are at 52.3%. Okay, that's really high, but it's the lowest in 4 years. It's still historically high, but moving in the right direction. We should be at around 40%. Okay, here's my take. The financial system is stable. Banks are well capitalized. Arrears are low. The renewal cliff is survivable. But the economy just tipped into a technical recession. Business investment has fallen 5 quarters in a row. Hiring has stalled. The Bank of Canada is sitting at neutral rates, telling us cuts may not be the answer. While inflation and energy prices continue to increase, that comes with potential rate hikes instead of the cuts the economy desperately needs. That's it for this week. Thanks for watching.